give a round of applause to Vitaliy, and let's ask him, because he had lots of things to say. Welcome, Vitaliy.
Thank you very much.
And just to make things easier for you, I'm going to ask the first question, which is funny because it was a question by someone who has exactly the same name as me, but you picked it up, actually. So he said, I would like to answer this question. So the first question goes as follows. What could go wrong with your investment process? Why? And then what?
Thank you so much. First of all, thank you so much for coming. I'm very excited to be here. I'm not sure I'm going to be engaging, but I'm going to be different. I can promise you that. Actually, I'm going to sit down. So Charlie Munger said, to answer the question, tell me where I'm going to die so I won't go there. And so the reason I like this question is once you try to figure out what could go wrong with your process, then you try to mitigate things so you don't screw up. So how could I be wrong doing what I'm doing? Well, there's three. By the way, just let me tell you a little bit about myself so you understand the perspective I'm coming from. So I run an investment firm. I'm a value investor. Our portfolio usually is going to have 20 or 30 stocks. So I spend 90% of my time doing analysis. By the way, can you guys hear me okay? Should I be, is that all good? Okay. So I spend most of my time doing analysis, doing research of stocks. So how can I screw up? What could go wrong with my process? Well, so there are three things could go wrong. Number one, I could be out of sync with the market. So I'm a value investor. I'm contrarian. So at the time when market is going crazy, when everybody is excited, when nobody cares about cash flows, usually my style will be out of sync with the market. So there is nothing wrong with what I'm doing, but my stocks will not be going up as much as the market is rising. So for that purpose, I do several things. We communicate to clients a lot. We write 3 or 4 letters a year that are 20, 30 pages long. Number one. Number two, we have clients who come to us for what we do. So if they don't like what we do, and if they want us to chase Nvidias and etc., then they had the wrong address. But at that time, when I'm out of sync of the market with the market, that's just basically just part of my job. That's part of the course. Okay, the second thing I could do is I can screw up on my stocks. We have a portfolio of 20, 30 stocks. I can almost guarantee you some of those stocks will not work out. And now I wish every single stock I ever touched, ever bought, went up. It's not going to happen. It's a really game of averages. So when that happens, I want to learn as much as possible. The most important thing, I don't want to blow up. This is why we have a 20, 30 stock portfolio. If I'm wrong on a few stocks, it's not going to kill me. It's going to wound my ego a little bit, but it'll be okay. So that's the second thing. The third one, another third way I can screw up, and this one is the one that worries me the most. It's I either get overconfident or underconfident. When, I'll give you an example. I'm giving you this example just to illustrate this. I'm having one of the best years in my career this year. They are up tremendously. And that scares me. So because I feel very, very confident. And that confidence scares me. So what we did this year, because I feel so confident, we actually went back and we studied our process. We make sure everything we're doing, there is arrogance does not, because when you're successful, you become arrogant. I wanted to make sure that arrogance does not spill into my process. And let me tell you this little story. Tiger Woods, when he won the American golfer, just FYI, I'm in France, I don't know. So American golfer Tiger Woods, when he was incredibly successful, he decided that his swing could be improved. So at the peak of his career, he basically decided that he's going to go and redo his swing. And when he did this, his performance actually declined at first, and then it came back and he was more successful. So this year, we happen to own a lot of European defense stocks. So that's helped our portfolio tremendously. And I was so scared because I felt like it's going to my head. Like I feel like I can walk on water. And so we went back and just completely, re-underwrote our investment process. So what really could kill an investor is when you get overconfident, or when you have a horrible year, you basically start believing in yourself. And by the way, that happened to me plenty as well. So at that point, again, you go back to your process. So those are the things that kind of can kill me as an investor. Yeah. I'm open to your questions. So yeah. Yes, please. In English, please, though. I don't know how that's going to happen, but here's Sonia.
Thank you, Thomas Streeter, Streeter Research. I see you play chess. Do you think chess players make better investors? And my second question is, how do you think about intangible assets and valuing intangible assets as a value investor?
Okay, so there's a, first of all, just because I have a Russian last name, my Russian first name, doesn't mean I'm good at chess. I do play chess, but I'm not very good at that. I'm not sure if chess would make me a better investor or not, I'll be honest. But I enjoy the game, and as I get older, I like the game because it makes it's almost like a mental exercise for a brain. So this is how I look at intangible assets. I always find it very difficult to value intangible assets. So instead of focusing on intangible assets, I focus on cash flows. And let me explain you how I look at this. I look at at the company's brand as it is intangible asset, right? And I see, does it show up in the cash flows or return on capital, right? And if company has a substantial brand or competitive advantage, it should, then it gives me more confidence in its cash flows. So therefore, it's going to show up in valuation because, first of all, may be willing to pay a slightly higher multiple for that. Or another way to look at it from discounted cash flow analysis, I can feel more comfortable looking forward 15 years out, 20 years out, because company has good brand, right? Which is basic. I mean, that's one of the intangible assets. Hopefully it helps. It's right there.
Hi, good evening. Christopher Dunn. I'm with Coalition Greenwich. You talked a little bit about decision making, your conviction in your decision making, and maybe a little bit of ego. How do you balance that out with, on the other hand, diversity of thought, building a good team? How do you draw that line to where you're incorporating your own thinking but bringing in other people's as well?
So, can you provide me the context a little bit, because I'm trying,
I just think there's always a conflict when you're working in a team.
Mm-hmm.
You have got your own ideas, and you're certainly the leader on the team.
Mm-hmm.
Part of your job is to hire smart people to make good decisions around you. But what if you're in conflict with those ideas? How do you come to conclusions together?
Got it. Okay. So I'm going to answer your question, but I'm going to take a slightly different approach to this, because there's a lot of people here who manage money. So when I started investing, I kind of, if you look at traditional kind of investment management firm, usually there is a portfolio manager and you have analysts. And this is how I started. I was an analyst and there was a portfolio manager. And at the time, my job was to pitch ideas to portfolio manager. Okay. And I'll be honest, I hated the structure. And here's why I hated this, because there is a symmetry of knowledge. I would spend 2 weeks doing research, and I had to compress this research into 15 minutes and deliver it to my portfolio manager in 15 minutes. Now, his liking or not liking idea in 15 minutes or less could have been impacted what he had for breakfast or whatever, right? And I hated this because all my work would have been completely wasted. So when I became a portfolio manager, I decided I'm not going to do that. So the way I work with my analyst is this, and that may answer your question partially. So before he picks a company to analyze, he comes to me and says, I think I want to study this. And most, 8 out of 10 times, he knows what I'm looking for. I'm going to say, yes, go study this. But the second he does this, I'm going to do the same research. So he may go deeper, but I'll do 70, 80% of the work he does. I'll read and listen or watch anything I can, about this company or the industry. He may go deeper and study footnotes, etc. But I'll do as much work as he does, and then it's him and I kind of debating this idea. Now, at the end of the day, we have an analytical framework with which we with which we operate. So it's very fairly objective, but it's going to be my decision. It's my neck on the line. I'm in France, so it's guillotine. So, so it's my neck on the line. So I'll be the one who will be making the final decision. But I create an environment where I invite debate. And I think he feels safe. And this is very important. You need to have an environment where people feel safe disagreeing with you. And I always invite this, and I always welcome it. And in this we have an environment where I'm the one who's going to make the final decision, but he feels like an equal, and because I'm doing almost as much research as he does. So was it helpful? Right. Thank you.
I need a couple of hints. Yes, and yeah.
Thank you. I'm Yushen from Trading Center. I have a question. What is your opinion or point of view on cryptocurrency as a value investor?
All right. Okay. I think my face gave it away a little bit. Okay. So this is such. Okay, cryptocurrency or cryptocurrencies, right? Like there's Bitcoin maximalists say there's only one God, which is Bitcoin, and then there's 10,000 other cryptocurrencies. So like if you asked me this question 2 years ago, my answer would have been different. I think what has changed over last year, less than a year actually, well, exactly a year since last presidential election in the United States, our president basically put an endorsement on Bitcoin. Once we elected Trump, he basically institutionalized and endorsed Bitcoin, which is, by the way, I think was a strategic mistake from the perspective of the U.S. government, because he basically endorsed competition for the U.S. dollar. So as Bitcoin has been institutionalized, and if you think about a currency for a second, I'm going to step back for a second. If you think about a currency, you can look at it from two perspectives. It's a story, and it's a network. It's a story in the sense when we were all born, we went to the store. Our parents took us to the store, and they took French francs or euros from or dollars and paid for milk. And you saw the story repeating all over the world. And we were told this paper is money. So as that's what currency is. It's basically a story that we accept as a society. Now, as the more people accept the story, the more valuable currency becomes. The more valuable currency becomes. Well, U.S. government basically just endorsed Bitcoin, and therefore I have no idea what it's worth. But 2 years ago, I wasn't sure if it's going to be here to stay. Now I'm quite certain it's not going anywhere. But the problem is, as a value investor, I have no idea how to value it. So it's maybe worth $5,000 or $500,000 or maybe $1. I have no idea. But it's in a sense that now I'm quite certain it's not going to go anywhere. So I'm not sure if it's helpful or not, but yeah. Other questions?
Yeah, hi Vitaliy, and thanks for the conference. David from Off Invest. My question falls back on something that you mentioned before your investment process. I'm curious to know, how do you invite this agency from your analysts and have them actually be confident in how they challenge your ideas if necessary?
So Seneca, a Stoic philosopher, had this great quote, very short. It says, "Time discovers truth." As an investor, my job is to discover truth before time does. So at the end of the day, when my analyst and I all we do is trying to figure out what the company is worth, right? So when we debate, we try the debate to be as tangible and as specific as possible. So it's not about it's not like I like this company, I don't like. It's not that. Usually it's about something very definable. Okay, we can talk about management quality, about their past decisions. We can talk about company's competitive advantage. We can talk about assumptions for growth. So when you have debates, they're not like, don't like. They're very narrow, very specific. This way we can be objective. So that's how we have these debates, because at the end of the day, the truth is going to be discovered by time. So we are just trying to figure out ahead of time what it's going to be like. So, in the book, there was a chapter called Abracadabra. That chapter talks about basically, discusses when we come to, let me just talk a little bit about this. Maybe that's going to be interesting. So there's basically 4 methods of communications, okay? There's a prosecutor when somebody basically goes to court and tries to convince the jury of something, right? You have a preacher when somebody goes to church and tries to convince the church or whatever in their message. And I'm going blank on the third one, but the fourth one is scientist mode. Okay, scientists, all they care about is figuring out. They have hypothesis, and they're trying to figure out, are they right or wrong? It's very objective. And so in our research process, we always try to be in a scientist mode, where I'm not trying to just win an argument. I'm just trying to discover the truth. So the scientist mode is always looking for truth. So that's how, I guess that's how I try to instill this in our firm. Yeah, please.
Wait for the mic. I'm sorry.
Thank you for allowing us to ask questions. Just wanted to ask you, when you start to tell yourself, I want to become a value investor, but you have already Buffett, Sonkin, Seth Karpman, and Peter Lynch out there. How do you manage to find your path to differentiate yourself as an investor, as a value investor in a field which is already maybe a little bit crowded?
Well, you mentioned Warren Buffett and Seth Klarman, right?
Yeah.
Okay. Well, they're very different investors. Yes. Very different investors.
But they both claim to be value investors.
That's right. Well, let's actually. Okay, this is good. So, what is value investing? Really, this is like. So, if you think of value investing, they usually. So, this is very interesting. There's usually you hear about value investing and growth investing. To me, actually, it's not even to me. Buffett talks about it all the time. It's a redundant term. There's either investing or not investing, or everything else. So value investing is basically very simple. When somebody is looking at the company, at the stock, not as a digits that trade on French Stock Exchange, Paris Stock Exchange, or New York Stock Exchange, but as a business. When somebody has a long-term time horizon, when somebody is when somebody is looking for margin of safety, that's just investing. That's just common sense. Now, I would argue like growth investing, value investing, all these different things, just biases. I'll give you an example. So there's also other biases: quality investing, low quality investing, right? So what is it like growth bias? When you look at a company that's growing earnings at a high rate, okay? Well, there's a lot of value in growth. I'll give an example. I'm a value investor. Our largest position today is Uber, which would not put me in a kind of traditional value investor category. But if Uber's earnings is going to be a lot higher in the future, and I'm very confident in that, then it's an undervalued stock. It may not be statistically cheap on today's earnings, but it's still an undervalued stock. Now, to answer your question, so does it make me growth investor or value investor? Well, I think if the company is undervalued and there's, I'm looking at the business and I have a long-term time horizon, and then I'm a value investor. Now we also own companies that may look statistically cheap, and they're undervalued. Then then I guess I'm a traditional value investor now. So the point I'm trying to make is this: I think as long as you come to this game as an investor, then the next step you have to do is find the approach that suits you. Seth Klarman and Warren Buffett are very different investors. Seth Klarman usually likes to buy this weird companies that have Warren Buffett would never touch those. And that's okay, because each one of them found, like when you choose your investment, when you choose your approach, you have to choose the approach that suits you. Warren Buffett could not do what Seth Klarman does, and Seth Klarman could not do what Warren Buffett does, even though they're still both doing value investing, and that's okay. It just, your approach has to suit your personality. Okay, I hope I answered the question. Yeah. Okay, thank you.
I have the micro. I'd like to have your view on the role of active management, given that in recent years, active management has tended to underperform passive management. And also because you mentioned your value investors, sometimes you need also a catalyst. How do you avoid value trap? Two different questions. And the third one is, what is the qualities, the best qualities to be a good portfolio manager?
Okay,
Three different questions, sorry.
Okay, so let's start with the first one, the active management.
Yeah.
Okay. Well, for the last 15 years, being an active manager was more difficult, right? Because if you basically, and there are many reasons for that, you had to embrace change in the sense that over the last 15 years, high quality, high growth companies, basically that now represent 40% of the S&P or index, basically dominated the returns. So the way I look at this is this: the more people embrace passive investing, the better it is for me. It's very simple. The more people buy, look, when people buy an index fund, they are not doing analysis. They just basically say, buy everything, I don't care about the price. That means somebody who cares about the price, I have less competition because the market gets slightly dumber. By the way, when I say this, I'm not insulting people who are buying it. I'm just saying it's a lot of people making decisions that requires zero analysis. So because by definition they're not doing analysis, just buy everything. So I think in the long run, the more people embrace passive investing, the easier my job as an active investor is going to be. Also, because when they do this, they create a lot of overvalued assets. If I avoid, at some point, I wrote my first two books, not this one, but the first two books were about market cycles. And if you look in the past, these tremendous bull markets usually followed by what I call sideways markets, where the markets go up and down and go nowhere. And that happens because when the stocks get expensive, then as they keep growing earnings, valuations decline and the stocks go nowhere. So as a value investor or as an active investor, I think that's going to be a tailwind for me because a lot of those passive strategies will be just stagnating and going nowhere. So that's your first question. Your second question was, you have to remind me.
The second question was was about how you avoid value trap. But as a follow-up to the first question,
and I'm going to say it's Jasmine because I know you are going to take the chance to say to you personally because it's just one question per person and no follow-up. I know it can feel like a dialogue because he's such a good speaker that there's a lot of people that would like to ask.
Okay, no worries.
This is why I'm saying it to you directly, but I should have said it as a housekeeping rule for it.
Okay. So maybe I leave my two other questions for for someone else. Yes.
Hello, David Montore, I work at La Française and also for CFA Society in the careers part. So I have quick question. I believe you already talked about some part of the growth company. So what is your opinion on Max 7 AI and like everyone lately talking about like probable bubble on it? What's your opinion on the topic?
All right. So, though I don't look that old, I did invest in the late 90s, in the very late, this is when I started my career. And in the late 90s, when the dot-com bubble was developing, there was a group of stocks that went up basically almost as much as the dot-com stocks, but they were real companies. Companies that basically, the telecommunication companies that build out fiber optic network. The names some of you may be familiar with would be Level 3 Communications, Quest, Global Crossings, and a few others. And those companies were basically laying millions of miles of fiber. And their argument was there is so much demand for that. And they were right. There was a huge demand. The internet. We are using a lot more bandwidth today than we're using 25 years ago, 27 years ago. But a couple of things happened. First of all, despite all the demand, we have a lot of still dark fiber today. Why? Because the compression, first of all, there is this concept in economics called fallacy of composition. And what it means is this: if you are at the football stadium and you want to see better the game, soccer game, let's say, and you get up to see it, you'll see it better. But if everybody else does it, nobody will see it well. Well, it kind of works the same way in this. If you're only one company that increases in capacity, you'll be fine. But if everyone does it, you're going to have overcapacity. I'm kind of trying to answer your question from afar. Now, the same thing applies to technology changes. So at the time when Level 3 was projecting the demand, what they were right about the demand. They probably were too conservative, but we did not see the technology will change, and that the compression of bandwidth will basically means we'll be able to take same gigabyte, compress it into 100 times, and send it through the same pipe. So my point is this: we had this huge build out of network, fiber optic network, and at the end, internet has happened. It was incredible, but we had overcapacity. Now, if you look at today AI, what's happened today? Today, every single company, Max 7 company, is spending billions of dollars, and every single CEO you talk to them, they tell you we can't afford to underinvest because we're going to lose. And Mark Zuckerberg said it, and Satya said it, the same thing. And that means that we're probably going to have overcapacity. That's number one. Number two, DeepSeek, the Chinese company, what they proved to us that a company that has a constraint in compute was able to create same model much cheaper, a fraction of the cost. So that means that, like, it's kind of like fiber optic again, right? So we may be overestimating, the AI is there, it's real, but we may be overestimating how much compute we need. And also there's a third factor, and the third factor is this: the demand for the internet has changed the world, but it didn't happen as fast as we expected to happen. And actually, the pivotal moment for internet was 2008. Why? Introduction of iPhone. It's our use of internet went exponential when we started to have a mobile device. And my argument would be that that exponential moment for AI is going to be robotics. So in the short run, I think we're going to have over investment. And by the way, the fiber optic story, that has happened time and time again throughout history. And I think in the 1800s, there was I know Britain for sure, but you guys probably as well built too many railroads as well. So this has happened throughout history. That's how progress happens, kind of one bubble at a time. So I'm looking today at Mach 7, and most likely we're going to have overcapacity, then we're going to have a correction, and then AI is going to be everywhere in our life, but it doesn't mean that they're good investments today. Hopefully I answered your question.
Another questions? I'm coming. Who raised their hands? No one? I thought that was someone. Oh, okay.
Came prepared. How do you use ChatGPT? And do you think that it's a threat for analysts, investment analysts?
That's Alejandro. Thanks so much. That's a great question. So I think AI today, all of us have a choice. We either embrace AI or we'll get run over by AI. Okay. Now we either embrace AI to help us think, or if we outsource our thinking to AI, it's going to make us dumber. I don't know how many of you looked at me signing books and you saw I have a horrible handwriting. I was born in Russia, so I used to have a perfect handwriting. But over the last 30 years, I stopped writing. So I lost that muscle memory. Now, if you outsource your thinking to AI, you're going to get dumber. I promise you that, because you're going to outsource that muscle memory of thinking to AI. At the same time, if you embrace AI as your friend, and a co-partner, partners in thinking, you become smarter. So I embrace AI. I don't let it write for me, because I don't want to lose the muscle memory of writing. Though I gotta tell you a secret. This is in America, people are very nice. They're very sunny. Like when they write you emails, they say, "I hope you're doing well," and it's usually a whole bunch of bullshit, the message, and a whole bunch more bullshit. Okay, I can't stand this. Okay, so the Russian in me just wants to have one sentence. So I literally write that one sentence, put it to AI, and say, "Make it American." And it's just like, what is one message turns into a page. And this is if you ever get a nice email from me, I do not write it. But anyway, so okay. No, but okay, coming back to AI. We today I have one analyst in my company, and we probably never gonna hire another analyst ever again. And there is a good reason for that. Because I think we can outsource a lot of kind of low value work to AI. I'll give you a couple examples to see how we embrace it. So I was listening to a conference call, one of our companies, it's a cable company, and they said, our prices for our product are cheaper than everybody else. I went to ChatGPT and I went into the pro mode, the one that takes like 20-30 minutes to do the work. And I basically said, compare prices for this company's product to everybody else. After 20 minutes, actually I went to in task mode, not even pro mode, task mode. It literally went to 5 or 6 different websites and checked the prices of T-Mobile to Verizon to AT&T and to other cable companies. And 20-30 minutes later, it gave me a table that says, here's the pricing. In the past, I could have an analyst do this, and it would take him maybe 5 or 6 hours. Here, 20 minutes in the background, it gave me the research. So we try to integrate AI as much as possible into our process, not to do thinking for us, but to help us think better. So I think this is very, very important, because I tell every single employee that you need to reprogram yourself, because until 2 or 3 years ago, you didn't think this way. But today, every time you have a question, I want you to be able to don't just come to ask me, but try to talk to AI and actually have a conversation about a question. I go for a walk in the park with my Grok or ChatGPT, and I talk to it about anything, like the oil industry. Like I just have a conversation about like if I was talking to another smart analyst or something. So if I wanted to learn about the industry, I do this all the time. So yeah.
You don't use this to receive like to get a shorter version or find.
Oh, we do this all the time. Yeah. No, no. No. Well, let me answer. Let me answer it anyway. But this.
No.
I am a speaker for Ruth. And it's not just me, we come up and say,
This is the last question.
Thank you. Too much pressure now. Hi, I have a question. Last time I was reading an article from the Wall Street Journal saying that actually it's a better idea to only invest in equities, even if you are near retirement. And I was quite surprised because, as you know, when you are near retirement, it may be a better idea to invest in bonds. And I was also surprised because, I mean, interest rates are increasing. So what do you think about this idea?
I think when people retire, they probably don't need so when you retire, you still have a long-term time horizon, not for all your money, but a portion of your money. So I think it somewhat makes sense to me because the money you need in the next 5 years or 7 years, you should not have that in equities because the stock market could decline over the next 5 or 7 years and you can't afford that volatility. But if you're investing for, if you're going to retire, you're going to live for the next 20, 30 years, part of your money, probably should be in equities, and part of your money, whatever you need for the next 5 or 7 years, probably should be, should be in the bond-like instruments, whatever that is. So to me, it makes a lot of sense. And by the way, it's just even if you retire, you have a pension of 50,000 euros. And you need $20,000 extra, €20,000 extra a year. So you just need to have $100,000 invested in bonds. And then the rest of your money can still be in equities because long-term returns from equities exceed returns from bonds. Now, there's a caveat here, is that the equities that you own are undervalued when you bought them. And this is a very important caveat because today, if you buy like US market index, you're buying a fairly overvalued asset. Okay, so I would argue this is not the question you asked me, but I would argue that today, based in the United States, 80 or 85% of our clients are in the United States. So we have clients all over the world. So it would have been easier for us just to invest in the United States, but 55-60% of our portfolio is outside the United States. We own French companies, we own British companies, and German companies, etc. So I think, as weird as it sounds, the value today is in Europe. So this is why we own a few French companies. But my point is, it's very dangerous when people say stocks or perform bonds, do better than bonds. That's true in the very long term, but it also matters how much you pay for those stocks. That was a kind of a question embedded in your question as well. So,
I think we have time for a last question. Who over there?
Yeah, I'm Roman. Question. Let's assume you know that AGI will happen in 2 years. What would you own?
Does everyone know what AGI means?
Artificial general
Let's start
intelligence.
with explaining, right?
So when it comes to AI, so there's a specific intelligence and there's general intelligence. And the specific intelligence is when AI basically dominates a certain domain, like that would be, let's say, self-driving. That's a very specific intelligence that relates to one narrow domain. Or radiology, like when AI in general intelligence, when basically AI has become a master in any domain. So I guess the question is, like, it's not another way to look at it. What is not going to change, right? And kind of basic needs, I would argue, but like, I'm not, in all honesty, I'm not sure I have a really good answer. Like, because like AI is changing so fast. Like every time I say, think about something. Okay, let me try to answer it this way because it's a very difficult question. Okay, so in the past, when I was thinking about AI, I would make this argument. I would say, if you look at the United States in the 1930s, 40% of the country, or something like this, worked in agriculture. Okay, then you had a mechanization, and you had combines, tractors, etc. And today, 2 or 3% of the country produces as much, even more than we produced before. Okay, so in the past I would say this is the progress, and this is what AI would do. And then I changed my mind, and the reason I changed my mind because this industrialization impacted few sectors. So the farmers went into to work at General Motors factories, etc. Okay, but AI is so pervasive; it's impacting so many industries that I have no idea how the future is going to look like. Because in the past, AI was supposed to just kind of replace blue collar jobs, robotics jobs, right? And now AI is killing a whole bunch of white collar jobs. So, in all honesty, I feel almost like this is an impossible question because we're going to get so many more data points in between, and I'm going to have to keep having a flexible mind and keep adjusting, because you have, like, 5 years from now is going to look so different than we ever expected before. And today, we have no idea what it's going to look like. So I think today, I think you have to be open-minded and be willing to keep changing your mind, because I keep changing my mind all the time now. So I'm sorry, that's the best I got. So
those are the best questions. Would you mind giving a big round of applause to Vitaliy? It was amazing.